Welcome to Stock Market course. Before we begin this course, I would like to introduce myself. I am Arun Kumar, the founder of AP Academy. With 6 years of experience, I have been teaching professional courses such as CA, CMA, CS, CAMA, ACCA, CMA US, CPA, and CFA. I have teaching experience with Google reviews, and one of my students achieved an All India rank. Coming to Stock Market course, you will learn basics of stock market, fundamental analysis, technical analysis, options trading and intraday, master the market. Let's start basics of stock market. Based on 2023 census, the proportion of people investing in stock market in various countries worldwide: USA 61%, Australia 51%, UK 42%, China 16%, India 9%. Out of 9% only, just 1% were successful in the stock market, which means 90% are losers in the stock market. Is there any reason? Yes. The primary reason is a lack of investment awareness. Many people follow other tips through platforms like Telegram, Facebook, YouTube, and other social media channels. Now, let's see. While comparing other countries, USA, the population is 34 crores. On that population, investing 61%. While compared to Australia, 2.6 crores out of 51% of people are investing in the stock market. But in India, only 9% are investing in stock market. And what about the remaining 91%? Let's see actually where Indians are investing in money. Real estate 51%, gold 15.5%, bank deposits 14%, securities 9%. Here, Indians are mostly invested in real estate and less invested in securities. Real estate appreciates due to surrounding development and infrastructure, while gold tends to increase in value due to limited supply. Bank deposits rise in response to inflation rate, and securities can rise based on the performance of issuing company. It's essential to understand the various factors that influence the various of different types of investments. Finally, get an idea of where you invest. Then, what is investment? First, you need to know about the savings. Savings, the act of putting money aside for a future need, is known as savings. Investing is similar to saving, but you are looking for higher return in exchange for taking on more risk. That means high return, high risk, less return, less risk, and medium risk will be there. Investment consists of securities like shares, stocks, debentures, bonds, etc. In respect to companies, we will see one by one. First, shares. A share represents a single unit of ownership in a specific company. When you own shares of a company, you own a portion of particular company. Let's take an example. If you buy shares of Reliance Industries, you own a part of Reliance Industries. If Reliance has issued 10 million shares and you own 10,000 shares, you have 0.1% ownership in the company. Then next, stocks. Stocks are a general term that represents ownership of one or more companies. Stock is a group of shares in one or more companies. Let's take an example. If you own shares in Tata Motors, Infosys, and HDFC Bank, you own stocks in these companies. Here, stocks refers to collective investment in various companies. Simply, stock is a collection of shares. Next, derivatives. Derivatives are financial instruments where value is derived from the performance of underlying asset, index or rate. They are used to various purposes including hedging, speculation, etc. Types of derivatives. Future contract. Agreement to buy or sell a particular quantity of a commodity or financial instrument at a predetermined price in a specified time in the future, usually a maximum of 3 months period to expire. Futures are used for hedging against price risk or for speculative purpose to profit from price movements. Types of futures like stock futures, contract based on individual stocks, index futures, contract based on stock market indices like Nifty 50, Bank Nifty, Fin Nifty. Commodity futures, contract based on physical commodities like gold, agricultural products. Currency futures, contract based on currency exchange rates. Interest rate futures, contract based on interest rates or bond. Options. Options in the stock market are financial derivatives that provide the holder the right but not obligation. So here obligation means commitment to buy or sell an underlying asset. So underlying an asset means stock, options or index options in a specified price with a specified time, usually weekly, monthly and maximum 3 months. There are two types of options. One is call option, right to buy. Another one is put option, right to sell. Know some basics. What is stock market, stock exchange and stock index? Stock market. The process and facilitation of investors buying and selling stocks with one another. Let's take an example in normal scenario. Like vegetable market, there are number of buyers, there are number of sellers in the particular market. That market is known as vegetable market. Like that, here also the facilitation is provided by NSE and BSE to exchange shares, the buyers and sellers. Stock exchange, the actual intermediary that connects buyers with sellers like NSE and BSE. NSE means National Stock Exchange, BSE means Bombay Stock Exchange. Stock index, a numerical representation of a group of stocks that is used to track their collective performance. Like Nifty 50, it related to 50 stock companies. Sensex, it related to 30 companies. Nifty IT, it related to IT companies. FinNifty, it related to finance companies. Bank Nifty, it related to banking companies. Like that. Who is the regulator of stock market in India? SEBI. Securities Exchange Board of India is the regulator of stock market in India. It ensures that securities market in India work efficiently and transparently. It also protects the interest of all participants. Who are the stock market participants in India stock market? India stock market is a dynamic. So here dynamic means change and a complex system with a variety of participants, each playing a crucial role in functioning. Who are they? Retail investors. Retail investors are individual investors who buy and sell securities for their accounts. They are characterized by relatively small transactions and typically invest for personal financial goals such as retirement or education. Institutional investors. Institutional investors include entities such as mutual funds. Let's take an example. They are collecting money from multiple investors and averaging them investing in stock market. Insurance companies invest premium collected from policyholders into the stock market to generate returns. Like LIC, pension funds manage retirement funds by investing in a variety of assets including stocks. Banks and financial institutions invest surplus funds in the stock market. Hedge funds employ various strategies to earn active returns for their investors. Foreign institutional investors. Foreign institutional investors are entities established or incorporated outside India. That purpose is invest in Indian financial market. They play a significant role in the stock market, often influencing market trends due to large volume of investments they manage. Domestic institutional investors. Domestic institutional investors are institutional investors based in India, including mutual funds, insurance companies, and banks. They often act as a counterbalance to foreign institutional investors, especially in times of heavy foreign outflows. Promoters. Promoters are individuals or entities. Entities means companies that establish a company and hold a significant portion of its shares. They play a crucial role in the management and strategic direction of the company. So, strategic direction means long term vision. Brokers and sub brokers. Brokers are intermediaries who facilitate the buying and selling of securities on behalf of client. Sub brokers assist brokers in these transactions. They earn a commission or brokerage fees for their services. Market makers. Market makers are companies employed by stock exchange to improve stock liquidity and trade volume in the market. They ensure that there are always a buyer and seller for securities, which helps in reducing price volatility. Example: Ashish Dhawan, Radhakrishna Damani, Share India Securities Limited, Geo Financial Services are the market makers in Indian stock market. Stock exchange. Stock exchange like Bombay Stock Exchange and National Stock Exchange provides a platform for the trading of securities. They ensure fair and transparent trading practices and are regulated by SEBI, Securities and Exchange Board of India. Who are the regulators? Let's see. SEBI, Securities Exchange Board of India, the primary regulatory body overseeing the securities market in India. SEBI role is to protect investors' interest, promote and regulate the securities market. RBI, while primarily responsible for monetary policy, the RBI also regulates entities like banks, NBFC, which are active in the stock market. Clearing house and depositories. Clearing corporation ensure the smooth settlement of trades by acting as intermediary between buyer and seller. They guarantee the settlement of trades, thereby reducing counterparty risk. Depositories provide depository service like holding and transferring securities in electronic form. The two main depositories in India are NSDL, CDSL. NSDL, National Securities Depository Limited, and CDSL, Central Depository Services Limited. Speculators and traders. Speculators and traders buy and sell securities frequently, aiming to profit from short-term market movement. They play a crucial role in providing liquidity to the market. As final, underwriters. Underwriters are typically investment banks or financial institutions that guarantee the sale of company initial public offering by buying unsold shares. They help companies raise capital from the market. Coming to the main topic, what are securities? Securities are tradable financial instruments issued by a company or government that grants ownership, debt, or ability to purchase, sell, or trade such instruments. Tradable financial instruments means shares, bonds, and debentures to buy or sell. Then see, what is securities market? Securities market is a place where buyers and sellers of securities can enter into transactions to purchase and sell shares. It performs an important role in enabling corporates and entrepreneurs to raise resources for their companies. Transfer of resources from those having idle resources to others who need them, corporates. Securities market provide a channel for reallocation of savings to investment and entrepreneurship. Securities market can be divided into two types. 1. Primary market. 2. Secondary market. Primary market. In primary market, company can sell shares to investors, that is public. Secondary market. In secondary market, existing shares are traded among investors, meaning they are already purchased in primary market. That shares are traded in secondary market. So here, existing shares are traded among investors, one investor to another investor to another investor. That secondary market is also known as stock market. Why do companies rise or need capital? Any reason behind that? The reason is to grow and expand their business. Rising of capital in the primary market in Indian stock market. Rising capital in the primary market involves company issuing new securities such as shares, bonds to investors for first time. This process is essential for businesses to raise funds for expansion, innovation, or other financial needs. Companies typically enlist the help of investment banks or underwriters to facilitate the offering. Investors participate in the primary market by purchasing these newly issued securities directly from the company, thus providing capital that can be used to fuel growth and development. This process is vital for both companies seeking funds and investors looking for opportunities to invest in promising ventures. In the Indian stock market, companies can raise capital in the primary market through various methods. What are they? First one, initial public offering. An IPO is when a company offers its shares to the public for the first time. It involves issuing new shares to investors and the proceeds go directly to the company. There is no relationship between others. IPOs are often used by growing companies like startups to raise substantial capital for expansion or provide liquidity to existing shareholders. Second, follow-on public offer. Similar to IPO, an FPO involves a public offering of additional shares by a company that is already publicly traded. The proceeds from FPO can be used for various corporate purposes, including debt repayment, acquisition. Acquisition means purchase or further expansion. That means you purchasing another company. A right issue allows existing shareholders to purchase additional shares directly from a company at a discounted price. This method gives existing shareholders an opportunity to maintain their ownership percentage in the company and raise additional capital without diluting their ownership. Let's take an example of right issue. I have 10,000 shares in Reliance Company. Reliance Company have 1 lakh shares. That means I have 10% ownership in Reliance Company. Suppose a Reliance Company have issue again 1 lakh shares. If I not purchase, what will be my ownership? Only 5%. How? Total capital of Reliance shares is 2 lakh shares. My shares is 10,000 shares. That will be 5%. So I have to maintain my ownership. I have to again purchase shares. That's why it is right issue. So this type of issue is known as right issue. So you have to maintain ownership. Whatever previously earned and future also same you have to earn. Preferential allotment. Companies can raise capital by issuing shares to specific investors such as institutional investors, promoters on a preferential basis. This method allows company to raise funds quickly from selected investors without going through the lengthy process of public offering. Okay, they are selected specifically. Qualified institutional placement is a method of raising capital whereby a listed company issues securities such as equity shares or convertible securities to qualified institutional buyers on a private placement basis. Qualified institutional placement are often used by established companies to raise capital efficiently from institutional investors. Private placement. Companies can raise capital through private placements by offering securities directly to a select group of investors such as institutional investors, high net worth individuals, or private equity firms. Private placements are typically less regulated than public offerings and offer company flexibility in structuring the offering. Conclusion. Each of these methods has its advantages and considerations, and company may choose the most suitable option based on their specific capital requirement, regulatory consideration, and market condition. Is there any eligibility requirement need for company? There are two exchanges. One is National Stock Exchange, another one is Bombay Stock Exchange. First, National Stock Exchange. What are the eligibility requirements for listing in National Stock Exchange? Listing a company on the NSE of India requires meeting specific eligibility criteria to ensure financial health, and governance standards. Here are the key eligibility requirements for listing on NSE. First, incorporation. The company must be duly incorporated under the Companies Act 1956 or 2013 in India or under the relevant laws in the case of foreign companies. The company must register in 2013 Act. So only company. Second one, paid up capital. The post-issue paid up capital of the applicant company face value must not be less than 10 crores and the market capitalization should be at least 25 crores. For small and medium enterprises platform, the post-issue paid up capital must be at least 1 crore. Next, net worth and profitability. For main board listing, the company should have a net worth at least 1 crore in each of last 3 full years and a track record of distributable profits in at least 3 out of preceding 5 years. Means the net worth and profitability will be positive. For SME platform, the company must have a positive net worth. Public shareholding. The company must have at least 20% of its post-issue paid up capital held by public with a minimum of 1000 public shareholders. Is there any track record? Yes, need. For main board listing, the company should have a track record of at least 3 years of consistent operations and the directors and promoters must not be debarred by SEBI. Here operations means business activities. For SME platform, the company should have a track record of at least 3 years of operations or in case of insufficient track record, the net worth should be at least 3 crores. Corporate governance. Corporate governance means a management of a company. Simply, who, board of directors, or those charged with governance. The company must comply with corporate governance requirements as stipulated by SEBI, which includes have a certain number of independent directors on the board, forming various committees like audit committee, nomination committee, remuneration committee. Next, due diligence. A due diligence report by a SEBI registered merchant banker is required. This report should confirm that the company has complied with all the regulatory requirements and is suitable for listing. Next, documentation. The company must submit various documents including but not limited to like draft red herring prospectus or red herring prospectus. So red herring prospectus is summary of what they issue of announcing. Annual reports of the last 3 years, memorandum and articles of association, corporate governance compliance reports, audited financial statements. So these are the documents needed for listing. Listing agreement. The company must enter into a listing agreement with NSE and comply with the continuous listing requirements stipulated therein. Other requirements. IPO grading. It is advisable for the company to obtain an IPO grading from a credit rating agency registered with SEBI. Although it is not mandatory, lock-in period. Promoter shares are subject to a lock-in period as per SEBI regulations. Conclusion. Meeting these eligibility criteria is crucial for a company to successfully list its shares on the NSE. The listing not only provides access to capital but also enhance the company visibility and credibility in the market. Here, eligibility requirements for listing in Bombay Stock Exchange. Listing a company on the Bombay Stock Exchange requires meeting specific eligible criteria. These criteria ensures that only companies with a certain level of financial stability and governance standards are allowed to list on exchange. Here are key eligibility requirements for listing on BSE. Number 1, incorporation. The company must be duly incorporated under Companies Act 1956 or 2013 in India or under the relevant laws in the case of foreign companies only. Paid up capital. For main board listing, the post-issue paid-up equity capital of the applicant company, the face value, must not be less than 10 crores. The market capitalization of the company should be at least 25 crores. Net tangible assets. The company must have tangible assets of at least 3 crores in each of preceding 3 full years as per latest audited financial results. So tangible means physical, you see. Profitability. The company should have a track record of distributable profits in at least 3 out of preceding 5 years. Alternatively, it should have a net worth of at least 5 crores. Public shareholding. The company must have at least 25% of its post-issue paid-up equity share capital held by public shareholders. There should be a minimum of 1000 public shareholders after the IPO. Track record. You have to maintain some track record. The company should have a track record of at least 3 years of operations under the same management. So here operations means business activities. In case the company has changed its name, at least 50% of the revenue for the preceding 1 full year should be from the activity suggested by the new name. Next, corporate governance. Already told, management of a company. The company must comply with the corporate governance requirements as stipulated by SEBI, including have a certain number of independent directors on the board and forming various committees like audit committee, nomination committee, remuneration committee. Due diligence. A due diligence report by SEBI registered merchant banker is required. This report confirms that the company has complied with all the regulatory requirements and is suitable for listing. Documentation. The company must submit various documents including but not limited to draft red herring prospectus or red herring prospectus, annual reports of the last 3 years, memorandum and articles of association, corporate governance compliance report, audited financial statements, listing agreement. The company must enter into a listing agreement with BSE and comply with continuous listing requirements stipulated therein. Other requirements. IPO grading. It is advisable for the company to obtain an IPO grading from a credit rating agency registered with SEBI, although it is not mandatory. Lock-in period. Promoters' shares are subject to a lock-in period as per SEBI regulations. Conclusion. Meeting these eligibility criteria is essential for a company to successfully list its shares on the BSE. Listing on the BSE not only provide access to capital but also enhance the company visibility, credibility and valuation. Why do companies get listed in the stock market? Companies choose to get listed in the stock market for a variety of strategic reasons. So strategic means long term. Here are some of the primary motivations behind a company decision to go public. Raise capital. Access to funds. By issuing shares to the public, company can raise significant amount of capital to fund expansion, research and development, acquisition, or to pay off existing debt. Here acquisition means purchasing of other companies. lower cost of capital. Public companies can often raise capital at a lower cost compared to private funding sources like venture capital, private equity, or through bank loans. Enhance liquidity. Marketability of shares being listed provides a liquid market for the company shares, allowing shareholders to easily buy and sell shares. Exit strategy for investors. Existing investors, including founders and early stage investors, can sell their shares more easily in the public market, like stock market. Increase visibility and credibility. Brand recognition. A public listing can significantly increase a company visibility of brand recognition and helping to attract customers, suppliers, and business partners. Credibility and prestige. Being listed on a reputable stock exchange can enhance a company credibility and prestige as it must adhere to stringent regulatory and reporting requirements. Diversify ownership. Broaden ownership base. Going public allows a company to broaden its ownership base, distributing shares among a large group of investors, which can include institutional investors, mutual funds, and individual investors. Not only promoters, but also some of them are there. Employee incentives. Public companies can use stock options and shares as part of employee compensation package, aligning employee interest with those of shareholders. So here company issue shares to employees through stock options. Facilitate growth and expansion. Funding growth initiatives. The capital raised from an IPO can be used to fund growth initiatives such as entering new market, developing new product, expanding existing operations. Merger and acquisition. Publicly traded shares can be used as currency for merger. So merger means two companies form one company. And acquisition. Acquisition means purchasing another company, making it easier for companies to grow through strategic acquisitions. Improve financial position. Debt reduction. Proceeds from IPO can be used to pay down debt, improving the company balance sheet and financial health. Improved valuation. A public listing can lead to a higher company valuation due to increased transparency, perceived stability. Regulatory compliance and governance. Enhance governance. The regulatory requirements of being a public company often lead to improved corporate governance practice, which can enhance overall management and operations. Transparency. Public companies must disclose financial and operational information regularly. So financial information means trading account, profit and loss account, balance sheet, cash flow statement, ratio analysis, comparative statement, different analysis, which can build investor trust and confidence. Strategic flexibility. Future fundraising. So strategic means you have to think in long term. That's why future fundraising. Once public, companies can raise additional capital through secondary offering more easily compared to private companies. Strategic partnership. Being listed can make it easier to form strategic alliances and partnership, as public companies are often seen as more transparent and reliable. Conclusion. Listing on Indian stock market offers companies a strategic advantage by providing access to capital, enhancing credibility, and increasing shareholder value. It facilitates growth, improve corporate governance, and open up new opportunities for merger and acquisition. While the listing process involves rigorous compliance and regulatory requirements, the long-term benefits often outweigh the initial challenges. What company can issue? The company can issue financial instruments in three forms like equity shares, preference shares, and debentures. Equity shares. These represent ownership in the company. Equity shareholders have voting rights for taking board of directors decisions and are entitled to a share of company profit in the form of dividends. However, they are the last to be paid in the event of liquidation. Preference shares. These are a type of equity but come with preferential rights over common equity shares. So preference means here fixed. Preference shareholders typically receive dividends at a fixed rate before any dividends are paid to equity shareholders and have a higher claim on assets than equity shareholders in the event of liquidation. So preference shareholders before equity shareholders. This one also I will tell later. Debentures. These are a type of debt instruments issued by company. Debenture holders are creditors of the company and receive interest payment at fixed intervals like 6 months, like 3 months once. Debentures can be secured. Secured means some property assets will be aligned, or unsecured, and they typically do not come with voting rights. So they are not involved in the management activities. In case of liquidation, debenture holders are paid before both preference and equity shareholders. So whatever they invest in the form of equity shares, preference shares, debentures. When company goes into liquidation, the liquidation means the company is winding up. The company is closing to the business. On that, who will receive first? Here getting the priority wise, first you have to pay debenture holders. After you have to pay preference shareholders. After only equity shareholders. Why equity shareholders? Simply, debenture holders get risk only, less risk. Already told that high risk, high return. Less risk, less return. Medium risk, medium return. So debenture holders risk is less risk. So that's why here getting first. Only whether profit in or loss. He getting interest regularly. Debentures getting interest regularly based on fixed period. After you have to pay preference shareholders in the form of fixed dividend. In the event of liquidation, first you have to pay debenture holders, then after you have to pay preference shareholders, then only you have to pay equity shareholders. So here equity shareholders are the main. So equity shareholders are also treated as owners of the company. In this, financial instruments can be classified into types of shareholders. Equity shareholders, owners of the company. The right to question the management of the company can be categorized as promoters, institutional investors. Next, preference shareholders. No right to question the management. Here, the right to receive the fixed dividend before payment to equity shareholders. Debenture shareholders, not owners but lenders of the company. Instead of dividends, they receive interest. Know what type of investor you are. There are three types of investors. One, growth oriented investor. Here, high risk appetite. High risk appetite means risk seeking. Longer investment horizon. Aware of possible short term equity losses. Balanced investor. Prefer moderate risk with suitable returns. Understand equity investment risk and look to reduce your exposure. Risk averse investor may have already attained set financial goal. More concerned about preserving capital than growth. Invest with the objective of meeting regulatory expenses or a safety need for emergencies. So now there are three types of investors: growth oriented investor, balanced investor, risk averse investor. Coming to shareholders, equity shareholder is a growth-oriented investor. He takes risk, that's why he get high returns. His thinking is long-term perspective. Second one, balanced investor. So balanced investor means he stabilizes returns with along with risk, that is preference shareholders. So he get medium returns. Risk averse investors or debenture holders, he didn't take any risk, he only protect his capital. Little return is enough. Market capitalization is used to determine the size and relative value of a company in the stock market. There is a formula is there. Market capital equal to current market price into number of outstanding shares of company will get market capital of that particular company. Based on market capitalization, companies are classified as have a market capital of 20,000 crores and above is treated as large cap companies. Having a market capital between 5,000 to 20,000 crores is treated as mid cap companies. Having a market capital up to 5,000 crores is treated as small cap companies. Categorization of stocks based on full market capitalization. Large cap first 100 companies. Mid cap 101 to 250th company. Small cap 251 and above. What are the characteristics of large cap, mid cap and small cap? Large cap. Investors consider large cap investments as a long term, possess a lower level of risk, a greater chance of generating consistent returns. It's usually less volatile and more liquid. So here volatile means in ocean the waves is like the waves movement is volatile. Okay, the wave movement is high, it will get some floods, tsunamis like that. Okay, the volatile movement will less. Mid cap. Investors with a long-term investment horizon that are moderately risk tolerant. Mid-cap stocks are riskier than large-cap stocks. Growth potential is moderate. Mid-caps are slightly more volatile and quite liquid than large caps. Coming to small cap. Investors who are aggressive and have short-term strategic goals. Small cap stocks are riskier than large cap and mid cap stocks. Small cap stocks have high growth potential. Small caps are extremely volatile and lack liquidity. In stock market, only you see bull and bear. Bull means rising, bear means falling. Okay, so here different types of trading animals in share market. So you only know bull and bear, but also some other animals there in stock market. So animals mindset, animals attacking style here we are seeing. Let's see what are they. Bulls, optimistic investors who pushes prices high. So bull attacking style like this. Okay, that's pushes the price high. Bear attacking style like this. They are pessimistic investors who believe the market will go down. When coming to market, there is a bull market or bear market. The market is bull means the market will rise. The bear market is the market will go down. Rabbits, they take a position for a very short period of time, like scalping. If you observe rabbits, their movement will be short run. After take some time, again some movement will be there. Same like that, in scalp traders, they are rabbits. Turtle, slow to buy, slow to sell. Their point of view is long term. So turtle's movement will be slow, like that, slow to buy, slow to sell. Their view is long term. Whales, extremely big investors who can move the market like domestic institutional investors and foreign institutional investors. Whales are big investors. Okay, so in whale, let's take an example. In ocean, small fishes are there. Here small fishes are retail investors. When coming into whale, all fishes will be eaten by whale. Same like that. In Indian market, the big investors are domestic institutional investors and foreign institutional investors. They will rise or fall. Okay, you have to, some cautious will be there. Tag. They look for opportunities, are neither bullish nor bearish, like option traders. Stacks, they look for opportunities, neither bullish nor bearish. Example, option traders. Only they are looking for opportunities. Sheep, they follow the herd and are not interested in developing their investing strategy. Sheep are moving like herd. One herd is moving, another sheep will follow in like that. They are simply following others. They are not making their own strategy. These are sheep. So in today's market, in Indian market, most of the people are sheep. Chicken, fearful investors who take lowest risk like debenture holders. Pigs, impatient, greedy, emotional, and the biggest losers in the market. Most of the people in the Indian stock market are pigs because they are 90% losers in the stock market because of impatient, greedy, over trading, emotional. These results biggest lose in market. So you get an idea what type of animal you need, like bull, bear, stag, whales, chicken, rabbits, tortoise. Next, what qualities are needed in the stock market? To succeed in the stock market, individuals need a combination of knowledge, skills, and personal attributes. Here, some qualities that can be beneficial for navigating the complexities of the stock market. Financial literacy. Understanding financial concepts such as company financial statements like profit and loss account, balance sheet, cash flow statement, ratio analysis. Valuation metrics and market dynamics is crucial for making informed investment decisions. Research skills. The ability to conduct thorough research on companies, industries, and market trends, whether it is uptrend or downtrend, can help investors identify promising investment opportunities and mitigate risk. So mitigate means minimize risk. Analytical thinking, being able to analyze data, interpret market trends, and evaluate investment opportunities critically is essential for making sound investment decisions. Patience. Successful investing often requires a long-term perspective, not short-term, and the ability to withstand short-term market volatility. So here long-term perspective is need patience. Patience allows investors to stay focused on their investment goals and avoid making impulsive decisions. based on short-term market fluctuations. Risk management. Understanding and managing risk is vital for protecting capital and preserving wealth. This includes diversifying investments. So diversifying investment means I'm not investing one company. I'm investing in different companies. That different companies is not related to one sector. So I'm investing in different sectors. That means diversifying. Setting realistic return expectations, not unrealistic. And using risk management tools such as stop loss. That's why you're protecting some capital. Emotional discipline. Keeping emotions such as fear and greed in check is essential for maintaining a disciplined investment approach. Emotional discipline allows investors to stick to their investment strategy during periods of market turbulence and avoid making irrational decisions. So market turbulence means market when it that period and avoid making rational decisions only, not irrational decisions. So here avoid making irrational decisions. Continuous learning. The stock market is constantly evolving. A willingness to adapt and learn new strategies, techniques, and market development is essential for long-term success. Decision-making skills. The ability to make timely and rational decisions based on available information is critical in the stock market, where market conditions can change rapidly. Self-awareness. Understanding one's risk tolerance, investment goals, and bias can help investors make investment decisions that align with their financial objectives and personal circumstances. So you have to aware yourself only. Resilience. The stock market can be unpredictable and investors may experience period of losses or underperformance. Resilience allow investors to bounce back from setback, learn from their experiences, and stay committed to their long-term investment strategy. By cultivating these qualities and combine them with a disciplined investment approach, individuals can increase their chances of success in the stock market over long term. Let's see some similarities and differences, their perspectives, one by one. Stock vs bonds in Indian stock market. Stocks and bonds are fundamental financial instruments that serve different purpose for investors and issuers. Here, a detailed comparison of the two in the context of Indian stock market. Stocks. Stock represent ownership in a company. Already told, stock is a collection of shares. When you purchase a stock, you become a shareholder and own a portion of the company equity. Equity means capital. Key characteristics. Ownership. Buying stocks gives a stake in the company. Stake means ownership, including voting rights and a claim on future profits. Returns. Investors can earn returns through capital appreciation. So capital appreciation means increase in stock price. Depends upon the market. And dividends, a share of the company profits. Risk. Stocks are subject to market risk, company specific risk, and economic factors, making them generally more volatile than bonds. Liquidity. Stocks are highly liquid and can be bought and sold easily on stock exchange like NSE and BSE. Example, purchasing shares of Tata Consultancy Service means you own part of TCS and benefit from its profitability and growth. Bonds. Bonds are debt instruments issued by corporations. Corporations means companies, municipalities or government to raise capital. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payment, and the return of principal at maturity. Example, 5 years bond is there. So at the end of 5th year, we will get principal. Every 6 months, you will get interest payment. Key characteristics. Bonds are essentially loans made by investors to issuers. So here issuers are company. Over the bond term and receive the principal amount back at maturity. So investors earn fixed interest like 5%, 6%, 7%. Over the bond term. That means bond term means suppose the bond is 5 years, 5 years will receive interest. At the end of the 5th year, I will receive principal. Risk. Bonds are generally considered safer than stocks, especially government bonds, but they carry credit risk. Credit risk means the issuer may default, he will pay later, and interest rate risk. Changes in market interest rate. Liquidity. Bonds can be less liquid than stocks, depending on the issuer and market conditions. Example, purchasing a Government of India bond means you are lending money to the government and will receive a regular interest payments plus the principal amount upon maturity. Comparison. So see the aspects between the stock and bond. First, nature. In stock, it is equity ownership. In bond, debt instrument. Return. In stock, will get return, dividends and capital gains. So capital gains means increase in the shares. In bonds, we will get only fixed interest payments and principal return. Risk. Higher risk in stocks due to market volatility. In bonds, lower risk depends on issuer credit worthiness. Liquidity. High liquidity, easily traceable on exchange, whereas can be less liquid than stocks. Ownership shareholder is the part owner of the company. Compared to bonds, creditor, lender to the issuer. Maturity. No maturity date in stocks. While compared to bonds, fixed maturity date is there. Income variable. Dividends can change in stocks, but bonds, only fixed interest will come. What are the advantages and disadvantages in stocks and bonds? Let's see advantages in stocks. Potential for high returns through capital appreciation. So capital appreciation means the movement of stock is increase or decrease. Dividend income also you receive. Ownership and voting rights in respect to companies. Disadvantages. High volatility and risk. Returns are not guaranteed. So that's why you are selling to another investor. The facility is available in stock market. Bonds. Advantages. Fixed and predictable returns. Lower risk compared to stocks. Priority over shareholders in case of issuer bankruptcy. Suppose the company is bankrupt. So first you have to settle debenture holders, after preference shareholders, after equity shareholders. Already you saw in previous topics. Disadvantages. Lower return compared to stock. Here risk is interest rate risk and credit risk is there. Less potential for capital appreciation. So there is no potential for your capital increasing. Only you will get fixed returns, that is interest. Conclusion. Where I invest, stocks or bonds? Both stocks and bonds play an essential role in investors' portfolio. So investors' portfolio means a group of stocks in respect to companies, offering different benefits and serving various financial goals. Stocks are suitable for those seeking higher returns and willing to accept higher risk. High return, high risk, you choose stocks. While bonds are ideal for conservative investors like risk averse investors seeking steady income and low risk. So low return, low risk. Bonus shares vs stock split. Bonus shares. Bonus shares also known as scrip dividend or capitalization issue or additional shares given to existing shareholders without any additional cost based upon the number of shares that a shareholder already own. These are issued by companies that have accumulated large free resource The issue of bonus shares increase the total number of shares but does not change the market capitalization of the company. Let's take an example. Company XYZ decides to issue bonus shares in 1:1 ratio. Before the bonus issue, an investor holds 100 shares. The market price per share is $50. After the bonus issue, the investor now holds 200 shares. That means 1:1 bonus share is there. So 1:1, the company is issuing bonus shares. So you already have 100 shares. Now it will be added again 100 shares. That's why it is 200 shares. 100 original shares, 100 bonus shares. The total value of the investment remains the same at $5,000. That value is 200 shares into 25. The value is same, but the shares are increasing. Assuming the price adjusts to reflect the increase in number of shares. Previous, the market value is 50. Now, the market value will be reduced to $25 and the shares increasing to 100 to 200. The company total number of outstanding shares doubles, but the market capitalization remains unchanged. Coming to stock split. A stock split involves dividing the existing shares into multiple shares to boost the liquidity of the shares. In a stock split, the number of shares increases, but the market capitalization remains same, just like in case of bonus shares. The face value of each share is reduced proportionately. Let's take an example. Company ABC announced a 2-for-1 stock split. Before the stock split, an investor holds 100 shares. The market price per share is $50. After the stock split, the investor now holds 200 shares. The market price per share is adjusted to $25. The total value of investment remains the same. 200 shares into 25, that equal to $5,000. The company's total number of outstanding shares doubles, but the market capitalization remains unchanged. Key differences in bonus issue versus stock split. Nature of issue. In bonus issue issued as a dividend to shareholders using the company free resource. In stock split, a division of existing shares to make them more affordable and increase liquidity. Impact on company resource. In bonus shares result in capitalization of resource. In stock split, no impact on the resource. Face value. In bonus shares, face value remains the same. In stock split, face value is reduced proportionately. Perception in market. In bonus shares, often perceived positively as a reward to shareholders. In stock split, seen as a method to enhance liquidity and accessibility. Summary. Bonus shares example. If you have 100 shares, $50 each, and you receive 100 bonus shares like 1:1 ratio and end up with 200 shares priced at $25 each. Stock split. If you have 100 shares at $50 each and there is a 2-for-1 stock split, you end up with 200 shares priced at $25 each. Both methods ultimately lead to an increase in the number of shares held by shareholders and a reduction in the share price, but they are done for different reasons and have different implications for the company, financials, and reserves. Let's see similarities between foreign institutional investors versus domestic institutional investors. In the Indian stock market, foreign institutional investors and domestic institutional investors play a significant role. Both terms refers to types of large-scale investors, but they differ in their origin and potential impact on the market. Let's see foreign institutional investors. Foreign institutional investors are investment entities established outside India that invest in the Indian financial market. These include mutual funds, pension funds, insurance companies, and hedge funds. Foreign institutional investors typically bring large amount of capital into the market, and their investment decisions can significantly influence market trends and investor sentiment. What are the key characteristics? Source: it is completely based outside India. Investment influence: high, as they often bring substantial capital. Impact on market: can cause significantly volatility, large inflow, large outflow, can move market indices. Regulatory environment: subject to regulations by SEBI, FIM must register with SEBI to invest in Indian market. Coming to domestic institutional investors. Domestic institutional investors are investment entities based within India. They include mutual funds, insurance companies, pension funds, and banks that invest in the Indian stock market. Domestic institutional investors provide a counterbalance to FI, often stepping in to buy when FI sell, and vice versa. Key characteristics: source: based within India, investment influence also significant but generally considered to provide stability. Impact on market: help mitigate volatility. Their buying and selling can stabilize market movements. Regulatory environment: governed by SEBI regulations specific to domestic institutions. Comparison and impact: while seeing market influence, FI are often seen as more volatile compared to DI because their investment decisions can be influenced by global economic factors, currency fluctuations, and geopolitical events, whereas DI, being local entities, are more influenced by domestic economic conditions and policies. To stabilization, DI tend to stabilize the market, particularly during periods of high FI outflows. Their presence provides a cushion against the potential adverse effect of sudden capital movement by FI. So here adverse means negative. Investment pattern: FI generally focus on large cap and high growth stocks, whereas DI might have more diversified approach, including mid cap and small cap stocks, driven by long term investment strategies like retirement and insurance funds. Recent trends: in recent years, the role of FI and DI have become more balanced in the Indian stock market. During periods of global uncertainty, COVID, FI might withdraw funds, leading to market downturn, while DI might increase their investment, providing support and stability to the market. Conversely, when FI are bullish, they can drive market rallies, which DI might then follow. Example: FI activity: FI were net buyers in Indian equities, with significant inflows during bullish global market conditions. For example, FI brought in substantial investments during the recovery phase post COVID-19 in 2021. DI activity: DI, particularly mutual funds, have seen increased inflow from retail investors, which has enhanced their capacity to invest. For example, DI have consistent buyers during market corrections, support market indices. Finally conclude, both FI and DI are crucial for the Indian stock market, contributing to liquidity, depth, and stability. Understanding their behavior helps in anticipating market movement and crafting investment strategies. So here anticipating means predict the future. Money market versus capital market. In the Indian stock market, the money market and the capital market play distinct yet complementary roles, catering to different investment needs and financial objectives. Let's see detailed comparison. First, money market in India. The money market in India deals with short-term borrowings and lending, typically for a period of up to 1 year. It is crucial for ensuring liquidity in the financial system. Key instruments: treasury bills, short-term government securities issued by RBI with maturity of 91 days, 182 days and 364 days. Commercial paper: it is unsecured, short-term promissory note issued by corporations like companies to meet their short-term funding requirements. Certificate of deposits: time deposits issued by bank with specific maturity date and interest rate. Repurchase agreement: short-term loans where securities are sold and later repurchased at a predetermined price and date. Call money. Short-term funds borrowed and lent among banks typically for one day. Who are the participants? Banks, financial institutions, mutual funds, corporations, and the RBI. Purpose of money market. Liquidity management. Helps manage short-term liquidity need of financial institutions and corporations. Monetary policy implementation. The RBI uses money market instruments to control money supply and interest rate. Risk and return. Generally low risk due to short-term nature and high liquidity of instruments resulting in relatively lower returns. Now, coming to capital market. The capital market in India deals with long-term funding and investment involving the trading of stocks, bonds and other long-term securities. What are the key instruments? You already know that equity, stock, shares representing ownership in a company. Traded on stock exchange like Bombay Stock Exchange and National Stock Exchange. Another one, bonds. Long-term debt securities issued by corporation, government or financial institution to raise capital. Debentures. Unsecured bonds that rely on the creditworthiness and reputation of the issuer. Mutual funds. Investment funds that pool money from multiple investors to purchase securities managed by asset management companies. Exchange traded funds. Investment funds traded on stock exchange, holding assets like stocks, commodities or bonds. Who are the participants? In capital market, individual investors, institutional investors like mutual funds, insurance companies and pension funds, corporations and the government. What is the purpose of capital market? Long-term funding. Provides a platform of raising long-term capital for business expansion, infrastructure project and other investments. What are the investment opportunities? It offers investors opportunity to invest in a variety of financial instruments with potential for higher returns. What is risk and return? Higher risk due to longer investment horizons and market volatility, but with the potential for higher returns compared to money market instruments. Comparison and impact in the Indian stock market. Let's see the difference between money market and capital market, comparison and impact. Time. Money market deals with short-term instruments up to 1 year, while the capital market deals with long-term instruments more than 1 year. So up to 1 year it is money market, more than 1 year it is capital market. Liquidity. Money market instruments are highly liquid. It is easily convertible into cash, providing quick access to funds, whereas capital market instruments are less liquid but can offer higher returns over time. Risk and return. Money market investments are low risk with lower returns, suitable for short-term liquidity management, while capital market investments carry high risk with potential for high returns, suitable for long-term wealth creation. Who are the regulatory bodies? The RBI regulates the money market, while SEBI regulates the capital market. Example, money market activity. The volume of transactions in the call money market, issuance of commercial papers and treasury bills are indicators of money market activity. Capital market activity. Trading volumes on the BSE and NSE, the number of initial public offering and the performance of key indices like BSE Sensex and NSE Nifty indicate capital market activity. Conclusion. Both the money market and capital market are vital for the overall health and efficiency of Indian financial system. The money market ensures liquidity and facilitates the RBI monetary policy, while the capital market provides avenues for long-term investments and capital formation, supporting economic growth. Let's see the similarities between futures and options versus equity trading. In the Indian stock market, trading can be conducted in various instruments with futures and options and equity trading being two of the most popular. Each has its unique characteristics, advantages and risks. Let's see detailed comparison. 1. Equity trading. Equity trading involves buying and selling shares of publicly traded companies on stock exchange such as BSE and NSE. What are the key characteristics? Let's see. Ownership. When you buy an equity share, you become a part owner of the company with voting rights and a claim on profit in the form of dividends. Investment. Suitable for both short-term trading and long-term investment. Market influences. So market influences. Stock price are influenced by company performance, market conditions, economic indicators and investor sentiment. Who is the regulation? Regulation governed by SEBI to protect investor interest and maintain market integrity. What are the advantages for equity trading? Potential for high returns. Long-term investment in equity can provide substantial returns due to capital appreciation. So capital appreciation means capital increase in the value compared to market value what you are invested. Dividend income, and also you receive dividend income. Shareholders may receive dividends as a portion of company profit. At the time of liquidity, stocks are highly liquid, allowing investors to buy and sell shares easily. So what are the risks? Market volatility. Stock price can be highly volatile, leading to potential losses. How to see company performance? Poor performance of a company can lead to a decline in stock value. Coming to futures and options. Futures and options are derivative instruments based on underlying assets such as stocks, indices, commodities, currencies. They allow traders to speculate on the price movement of these assets. Let's see characteristics. Contractual obligation means commitment. Future contract obligate the buyer to purchase and the seller to sell the underlying asset at a predetermined price and date. Specific date normally maximum 3 months. Standardization. Contracts are standardized in terms of quantity, quality and delivery date. Leverage. Futures trading involves need margin, allowing traders to control large position with a relatively small amount of capital. No need huge. What are the advantages? Hedging. Investors can hedge against price movement in the underlying asset. Leverage provides the opportunity to earn significant returns with a small initial investment. What are the risks? High risk. Leverage can amplify losses as well as gains. Margin calls. If the market moves against the position, additional funds may be required to maintain the margin. Let's see options. Key characteristics: right, not obligation. Options gives the holder the right but not the obligation. That means commitment to buy. In call option, in put option you sell the underlying asset at a predetermined price within a specified period. Minimum weekly expiry there, monthly expiry there, and maximum 3 months expiry will be there. Premium. The buyer pays a premium for this right. What are the advantages? Limited risk for buyers. The maximum loss for an option buyer is limited to the premium paid. Flexibility. Option can be used for various strategies, including hedging, speculation, and income generation. What are the risks? Complexity. Option trading can be complex and may require advanced knowledge. Potential for loss. Sellers of option face potentially unlimited losses if the market moves against their position. Let's see, compare between equity trading versus futures and options trading. 1. Purpose. Equity trading suitable for investors looking to gain ownership in companies and benefit from long-term growth. Compared to F&O, ideal for investors looking to hedges, speculate or leverage their position in the market. Coming to risk and return, while equity trading, direct exposure to market risk and company specific risk with potential for higher returns over the long term. While F&O, higher risk due to leverage and the complexity of derivative instruments with the potential for both significant gains and losses. Investment horizon. Equity trading can be used for both short-term trading and long-term investment, while F&O typically used for short to medium-term trading strategies. Market influence. In equity trading, influenced by company performance, market conditions, and broader economic factors, while F&O influenced by the price movement of the underlying asset, volatility, and time decay. Conclusion. Both equity trading and F&O trading play vital role in the Indian stock market, catering to different types of investors and traders with varied risk appetites and investment strategies. Understanding the differences, advantages, and risk associated with each can help investors make informed decisions aligned with their financial goals. Let's see which trading is better, whether it is futures trading or options trading. Futures and options are both derivative instruments traded in the Indian stock market, allowing investors to hedge risk or speculate on the future direction of asset prices. Here, detailed comparison of futures and options trading. Let's see futures trading. A future contract is an agreement to buy or sell an asset such as stock, indices, commodities, or currency at a predetermined price on a specified future date. What are the futures? Obligation. Both parties, buyer and seller, are obligated to execute the contract at the agreed price on the expiry date. So maximum 3 months. Standardization. Contracts are standardized in terms of quantity, quality, and delivery date. Margin requirement must. Traders must maintain a margin, initial and maintenance, to ensure a contract margin are typically a percentage of the contract value. Mark to market. Daily settlement of profits and losses based on the market price, requiring daily adjustments to the margin. Leverage. High leverage allows control of large positions with a relatively small capital outlay, which can amplify both gains and losses. What are the advantages of futures trading? Liquidity. Future markets are highly liquid, facilitating easy entry and exit. Price discovery. Future markets help in efficient price discovery due to high trading volumes. Hedging. Effective tool for hedging against price fluctuations in the underlying asset. Some disadvantage is there. Risk. High leverage can lead to significant loss. I already told that high risk, high return, especially if the market moves unfavorably. Complexity requires a good understanding of margin requirements and market dynamics. Then only you are able to survive futures trading. Then coming to options trading, an option contract gives the buyer right but not the obligation. Here obligation means commitment to buy or sell an asset to a predetermined price before or on the expiry date. The expiry date will be weekly, monthly, maximum 3 months. What are the futures? Let's see. Rights versus obligation. Buyers of option have the right but not the obligation. So buyers of options have the right but not the obligation to execute the contract, while sellers have the obligation means commitment if the buyer exercises the option. Here sellers means writers, buyers means holders. Premium. The buyer pays a premium to the seller for this right. Types of options. There are two options. Call option, right to buy the underlying asset. Put option, right to sell the underlying asset. So underlying asset means stocks, indices, currency, whatever. Strike price is very important in options trading. The price at which the option can be exercised. Expiry date is also important. The date by which the option must be exercised. It depends upon weekly, monthly, and maximum 3 months. What are the advantages in options trading? Limited risk for buyers. Maximum loss is limited to the premium paid for the option. Flexibility. Options can be used for various strategies like hedging, speculation, and income generation. Leverage. Like futures, options provide leverage but with limited downside risk for buyers. But disadvantage is also there. Complexity. Options are more complex due to factors like time decay, volatility, and multiple strategies. Time decay. The value of option decreases as the expiry date approaches, especially if they are out of the money. Totally money loss. Premium cost. Buyers must pay premium, which can be substantial in volatile markets. Let's see comparison between futures trading and options trading. Obligation, futures, yes, obligation is there. While options, only for seller. Risk unlimited. Potential loss in options limited to the premium paid. Leverage high both in futures and options trading. Cost margin requirement in futures trading. In options, premium payment will be needed. Complexity moderate in futures trading, high in options trading. Strategies lower, higher. Let's see the practical example. Futures, an investor expects the price of Reliance Industries to increase in the next 3 months, they buy a futures contract. If the price rises, they profit. If it falls, they incur a loss. Coming to options, the same investor buys a call option on Reliance Industries. If the price rises above the strike price, they can buy at the lower price and sell at the market price for a profit. If the price falls, their loss is limited to the premium paid. Conclusion. In summary, futures and options are powerful tools in the Indian stock market, each with its own advantages and risks. Traders should choose based on their risk tolerance, market outlook, and investment strategy. The differences between trading versus investing in the Indian stock market. Trading. Trading involves buying and selling stocks or other financial instruments frequently, like regularly, often within a short time frame. Traders capitalize short-term market fluctuations to make profits. Types of trading. There are many types. Day trading. Buying and selling securities within the same trading day to profit from small price movements. Swing trading. Holding stocks for several days, weeks to capitalize on expected upward or downward market shift. Scalping. Making numerous trades throughout the day to scalp small profits from each transaction. Positional trading. Holding positions for weeks or months based on long-term market trends. So what are the key characteristics? Short-term focus involves short investment. Horizon ranging from minutes to a few months. Duration. Frequent transactions regularly. High volume of trades leading to high transaction cost. Needs technical analysis. Relies heavily on charts, patterns and technical indicators to predict future price movements. What are the risk and return? High risk due to market volatility, but with potential for quick, substantial gains. So high risk, high gains. What are the advantages in trading? Potential for quick profits. Traders can take advantage of short-term price movement. Utilization of leverage. Traders can use margin to increase their buying power and potential returns. Flexibility. Traders can adapt quickly to market changes and new information. Risk also there. Market volatility. High volatility can lead to significant losses. Emotional stress requires constant monitoring of the market, which can be stressful. Transaction cost. Frequent trading incurs high brokerage fees and taxes. Next, coming to investing. Investing involves buying stocks or other financial instruments with the intention of holding them for extended period, often years or decades. Investors aim to build wealth gradually through long-term capital appreciation and dividends. Types of investing. There are many types. Let's see. Value investing. Buying undervalued stocks with strong fundamental and holding them until their market value reflects their intrinsic value. Growth investing. Investing in companies expected to grow at an above average rate compared to other companies. Dividend investing. Focus on stocks that pay regular dividends, provided a steady income stream. Characteristics of investing. Long-term focus, longer investment horizon, typically years or decades, fewer transactions, less frequent buying and selling resulting in low transaction cost. Need fundamental analysis, emphasis on company fundamentals including earnings, revenue and management quality. Risk and return. Lower short-term risk due to market fluctuations with the potential for significant long-term gains. What are the advantages? Compound growth. Benefits from the power of compounding over time. Transaction cost is reduced. Fewer trades lead to low brokerage fees and taxes. Stress will be less. Long-term perspective reduces the need for constant market monitoring. But risk also there. Market risk. The value of investment can decrease due to market downturns. Opportunity cost. Funds tied up in long-term investment may miss out on other opportunities. Company risk. Poor performance of a company can affect in stock value. Let's see comparison. Time. In trading, short term, minutes to months. In investing, long term, years to decades. Focus, capitalizing on short term. In investing, building wealth over time. Transaction, high, here, low in investing. Analysis, technical analysis need in trading, while fundamental analysis need in investing. Risk level, high due to volatility in trading, lower short term risk in investing. Returns, high short term gains, significant long term growth. Transaction cost, high, low. Emotional stress, high, low. Let's take an example. While trading, traders may focus high volatility stocks like small cap companies or sectors like technology and pharmaceuticals, which often see rapid price changes. Coming to investing, investors might target blue chip stocks. Blue chip stocks means large cap companies such as Reliance Industries, TCS, HDFC Bank, known for their stability and long term growth potential. Conclusion: both trading and investing have their unique benefits and risks. The choice between trading and investing depends on individual financial goals, risk tolerance, time commitment, and market knowledge. Trading can be rewarding but requires significant time and expertise, while investing typically involves a long term strategy with a focus on gradual wealth accumulation. Let's see which trading is better, index trading, while stock trading. Index trading. Coming to index trading involves buying and selling of financial instruments that track the performance of a market index. In India, popular indices include Nifty 50 and BSE Sensex, FinNifty, Bank Nifty. What are the key characteristics? Typically involve derivatives such as index futures and options, as well as exchange trade funds that replicate the performance of an index. So, index means a group of stocks. Diversification. Provide exposure to a broad range of stocks within the index, reducing company specific risk. Market sentiment. Index trading reflects overall market sentiment and economic conditions rather than individual company performance. What are the advantages? Diversification. Reduce the risk associated with investing in individual stock by spreading investment across multiple companies with the index. Lower volatility. Indices tend to be less volatile compared to individual stocks due to the diversified nature. Easy of investment. Allow investors to gain exposure to the market as a whole without having to pick individual stocks. Hedging. Index futures and options can be used to hedge against market downturns. But risk also there. Market risk. Subject to market wide risks such as economic downturn, political instability, and global events. Limited upside. Potential for gains may be limited compared to individual high growth stocks. Coming to stock trading. Stock trading involves buying and selling shares of individual companies listed on stock exchange like NSE and BSE. Characteristics. Ownership. Buying stock means owning a part of the company with voting rights and a claim on dividends. Individual performance. Stock prices are influenced by specific company performance, management decisions, and industry trends. Potential for higher returns. Individual stocks can offer significant returns if the company performs well. Let's see advantages. High potential returns. Individual stocks, especially those of high growth companies, can offer substantial returns. Dividends. Investors can earn regular income through dividends. Control and choice. Investors can select companies they believe in and track specific industries. But risk also there. High volatility. Individual stocks can be highly volatile and subject to company specific risks such as poor earning reports or management issues. So thorough research analysis will be there. Requires thorough research analysis of each company to make informed decisions like fundamental analysis, liquidity. Stocks of smaller companies may have lower liquidity, making it harder to buy or sell large quantities without affecting the price. Let's see comparison between index trading and stock trading. Focus trading, index trading, broad market performance. In stock trading, individual company performance. Index trading, index, futures, options, stocks. Instruments in index trading, instruments are index futures, options. In stock trading, ETFs, individual stocks. Diversification, high across all companies index, low to medium depends on portfolio volatility. While compared to stock trading, lower due to diversification, higher especially for small cap stocks. Risk level, market risk. In stock trading, company specific and market risk. Research requirement, lower in index trading, focus on overall market. In stock trading, higher research requirement need in-depth analysis of companies. Research requirement need in stock trading requires in-depth analysis of companies. Potential returns, moderate, align with market trends. In stock trading, high, dependent on individual stock performance. Used for hedging, effective. Let's see example. Index trading. Nifty 50 index, which includes top 50 companies listed on the NSE, and the BSE Sensex, which includes 30 well-established companies on the BSE, are commonly traded indices. Stock trading. Popular stocks include large cap companies like Reliance Industries, Tata Consultancy Services, and Infosys, as well as mid cap and small cap stocks for more aggressive growth potential. Conclusion. Which trade is better? Both index trading and stock trading offer unique advantages and cater to different types of investors. Index trading is suitable for those looking for diversified exposure to the market with lower volatility, while stock trading is ideal for investors seeking higher returns through individual stock selection. Understanding your financial goals, risk tolerance, and market knowledge is crucial in choosing the right approach of index trading or stock trading. Next topic, types of traders. In the Indian stock market, various types of traders operate, each with different strategies, risk appetite, and time horizon. Here a detailed overview of the primary types of traders. One by one see. Day traders. Traders who buy and sell stocks within the same trading day, often closing all positions by the end of the day, are treated as day traders. What are the characteristics? Time horizon. Very short term, typically minutes to hours. What is their objective? Capitalize on small price movement within a single trading day. What are the tools are used in day trading? Use technical analysis, charts, and real-time market data. What are the risk and reward? High risk due to market volatility and leverage. Potential for quick profits can earn substantial returns in a short period. Let's take an example. A trader buying shares of a volatile stock in the morning and selling them before the market closes to profit from intraday price swings. Next, swing traders. Traders who hold stocks for several days to weeks, aiming to profit from short to medium term price movement. Characteristics: time short to medium term from a few days to a few weeks. Objective: capture trends or swing in the market. What are the tools are used in swing trading? Combine technical analysis with fundamental analysis. What are the risk and reward? Moderate risk, less exposure to intraday volatility, but subject to overnight market risk. Potential for steady gains, can achieve consistent returns over time. Let's take an example. A trader identifying a bullish trend in a stock and holding the position for several weeks until the trend peaks. Next, scalpers. Traders who make numerous trades throughout the day to scalp small profits from each trade. Time very short term, often seconds to minutes. What is their objective? Profit from small price changes. What are the tools are used in scalping? High speed trading platform and real time data. What are the risk and reward? High risk requires precision and quick decision making. Small frequent profits relies on high volume of trades to generate significant returns. Let's take an example. A trader executing dozens or hundreds of trades within a single day, profiting from minor price fluctuations. Next, position traders. Traders who hold positions for several months to years, focusing on long-term trends. Characteristics: time, long-term, from several months to years. Objective: benefit from major market trends. What are the tools are used in position trading? Fundamental analysis, economic indicators, and market trends. What are the risk and reward? Lower risk, reduced to exposure to short-term market volatility. Potential for significant gains, can achieve substantial return by capitalizing long-term trends. Let's take an example. A trader buying shares of a company expected to grow significantly over the next few years and holding the position to realize long-term gains. Next, arbitrage traders. Traders who exploit price differences of same asset in different markets or firms. Characteristics: time, short term depending on the opportunity. Objective: profit from price discrepancy. Tools: advanced algorithm and real-time data need. What are the risk and reward? Low risk. Typically low risk strategy that involves simultaneously buy and sell actions. Returns: modest. Generally small profits per transaction, but high frequency can yield significant total returns. Let's take an example. A trader buying a stock on one exchange where it is undervalued and simultaneously selling it to another exchange where it is overvalued. Next, momentum traders. Traders who buy stocks experiencing an upward trend and sell them when the trend reverses. Characteristics: time, short to medium term, depending on the strength of the trend. Objective: profit from continuing trends. What are the tools are used? Momentum indicators and trend following strategies. What are the risk and reward? Moderate to high risk. Trends can reverse unexpectedly. Potential for high returns. Profiting from substantial trends can yield significant gains. Let's take an example. A trader buying a stock that has shown strong upward momentum over the past few days and selling it once signs of reversal appear. Conclusion: each type of trader in the Indian stock market has a distinct approach and strategy, catering to different financial goals, risk tolerance, and market conditions. Understanding the characteristics, risk, and reward associated with each type of trading can help individuals choose the strategy that best aligns with their investment objectives.